Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended October 21st, 2015. I'll be reporting flows for the conventional fund business, ex-ETFs originally, but we'll be talking a little bit about ETFs. Conventional fund business actually lost about $400 million this week. Not anything really to write home about. You know, people were sitting on their hands, a lot of hand-wringing going on with the idea that we're in the third quarter earnings seasons. It's been a hit and miss type of earnings season, and we've had some actually fairly good economic news out there. Had some bad news come out about China. They theoretically had a Q3 growth rate that was only 6.9%. Everybody was expecting 7%. At least that's what the government expected. But really, people saw this as a good sign. They thought that might have the Chinese government actually injecting money to prop up Beijing and the like. So it was kind of an interesting week as well. Towards the end of the week, people saw some discouraging news, but at the final portion of it, we actually heard that the housing market was doing better than expected. So we had mixed news, but again, people are just waiting to see what pans out for Q3, and let's see how that affected the flows for our macro groups in the mutual fund industry. Equity funds saw about $200 million in outflows, almost nothing to write about. Taxable bond funds, though, on the flip side, saw about $2.3 billion come into their coffers. Muni bond funds saw a slight outflow, $148 million, and we saw money market funds actually take a money market fund saw about $2.6 billion in outflows, and actually I said that incorrectly. Muni bond funds actually saw an inflow again, about $148 million on inflows. Well, let's see how these individual groups actually break out and take a look at equity as a particular asset class. Equity funds had a pretty good return. Remember, I told you it was kind of a mixed market, but it ended up about 0.8% up. So just barely, just short of 1%. But again, it was a positive return. It's the second week in three that we've actually seen positive returns. But again, we saw about $166 million in outflows. Fourth consecutive week that we've seen outflows. Here's the interesting fact, though. Domestic equity funds lost about $800 million. It's the fourth consecutive week they've seen outflows. But non-domestic equity funds, again, took in money, about $600 million, and it's the first week in four they've seen some positive numbers come about. How it broke out, if we take a look at equity income funds, they lost the biggest share, about $900 million. And then we take a look at real estate funds, and real estate funds saw a little bit of outflow as well, about $300 million. So really it was kind of those interest-paying areas that took it on the chin. Everybody else was kind of just moderately positive. But if we take a look at the international equity arena, that's where most of the money went, about $600 million. So a light outflow out of emerging markets to a tune of about $200 million. Well, let's take a look at what happened in the ETF universe. That's a little bit different. Second consecutive week, we've seen big inflows. $4.5 billion came in. But this is where the dichotomy was a little bit different. It was a risk-on mode. Basically, we saw iShares, the iShares Russell 2000, taking about $591 million. Not a big amount of money. Spider Spider S&P mid-cap fund took in the next largest group, about $433 million. And then at the bottom, we see SPY, actually losing money. So people were getting rid of kind of the big safety areas and, again, putting on a little bit of risk. And, again, $424 million as far as outflows there. And then in industrial select sector funds, Spider was also witnessing outflows, about $423 million. So, again, kind of a risk-on taking week for ETF or authorized participants. Let's see how this panned out to our fixed income universe and see how that compares. For the second consecutive week, we've actually seen inflows, $2.3 billion. This is the third consecutive week, though, we saw plus side returns, this time to the tune of about 0.19%. Nothing to write home about. Again, it's a weekly return, but again, positive. What's really unique, though, is, again, risk on here, and this is from mutual fund investors. We saw high yield funds taking about $2.3 billion, and it is the third largest inflows that they have seen on record, and the largest inflow into this group since 2011. So that was quite a change. Interesting enough, we saw corporate investment grade debt funds, which was kind of the safe haven play that people were playing, actually loses the biggest amount. About $800 million flowed out of their coffers. Let's take a look now, though, what happened in the ETF arena. Very similar, by the way. We took a look. $2.1 billion came into that group. Third consecutive week of net inflows. iShares iBox investment grade corp. So again, they weren't shutting the corporate grade investment funds. They actually took in, one of the bigger flows, about $771 million. And then we had the Spider Barkley high yield ETF taking about $582 million. And at the bottom, if you take a look, it's just a whole bunch of short treasuries. And that's certainly what's been popular over the last several weeks. iShares Short Treasury Bond Fund lost the biggest share, about $541 $1 million left their coffers. Let's turn our attention to muni bond funds. As I stumbled at the beginning, we saw about $148 million of net new money come into their coffers. It's the third consecutive week they've seen money come in to that group, and it's the fifth consecutive week of plus side returns. As you can see on the chart, though, 0.09% return. So again, it was on the plus side barely. You could probably call it zero, but nonetheless, it was on the plus side. National munis took in the biggest amount of money in that group. About $164 million came in. So that means that we had single states actually losing some money as well. Let's turn our attention to a last asset class, and that is money market funds. Money market funds for the first week in 5 saw outflows, $2.6 billion. Again, risk off. Taxable money market funds actually saw about $1.4 billion, how that broke out. We had institutional investors redeem about $400 million, and we saw about $1 billion come out of retail accounts. Tax-exempt money market funds lost about $1.2 billion. Well, that's it for me this week. If you want to do a deeper dive, check into your portfolio or check into something else that you want to take a deeper dive on, go to www.lipperusfundflows.com. There you can find a little bit more about what's going on in the group that you'd like to take a look at. And if not, you can join us next week when one of our analysts will talk about flows. Thanks for joining me today. My name is Tom Rosine, wishing you the best in your wealth planning and creation.